Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Aga tutor, Mr. J. Mutumkulu, and in this video, I'm going to elaborate, or let me just say, to explain a few things related to statement of cash flows, which are an aspect under International Accounting Standard number 7, that is statement of cash flows. Now we have sent you, much of the details, study materials in the previous week. Okay, so this is just an addition to those materials. I have realized that a lot of students are finding it difficult to grasp the concepts. So in this video, I'll try to explain the basics in a much step-by-step approach. Okay, so we have already learned that statement of cash flows are prepared to provide information on cash generated by an entity and how that cash was utilized in the reporting period. A statement of cash flows focuses on cash and liquidity, highlighting movements in liquidity, thereby allowing users of financial statements to see how cash was generated and utilized. So we are mainly concerned with the liquidity of the company, and liquidity is a philosophy that speaks about cash as the lifeblood of a business. Okay, so if we have got cash, we are said to be much liquid. Okay, but if we don't have, then we are dry. Now, by analyzing trends of a period of time, users are able to assess the ability of the entity to generate and maintain sufficient levels of liquidity to pay obligations as they fall due. This trend analysis can also give indications of distress. Okay, let me try to disable my network here. All right, just to avoid interactions. We don't want to be interrupted, and we don't want personal information of my contacts to be seen on the screen. I'm sorry for that. Okay, so by analyzing trends over time, we are able to see if the company is in financial distress or not. Okay, so these statement of cash flows are an essential part of reporting. Now, presentation of the statement of cash flows. In terms of this accounting standard, that is International Accounting Standard number 7, statement of cash flows, accountants or preparers of financial statements are required to report cash flows, okay? Cash flows of a company under 3 headings, all right? The first heading is the cash flows from operating activities. This one relates to the main income generating activities of the entity, the ordinary activities of the entity, okay? How it generates money. I mean, the purpose of the business being created. Okay, so incomes from these activities are considered to be the main sources of income. All right. So these income sources are very essential, and managers should strive to ensure that the sources are as active as possible. All right, because by the end of the day, we don't expect a company to raise its income from the disposal of its non-current assets. That's not the main aim of the business. But here we expect income from trade. All right, so trade income, that's the one that has to be reported under this subheading. This heading. Then there is heading number 2, that is cash flows from investing activities. This involves the purchase and disposal of non-current assets. All right, when we buy a non-current asset, we are, in terms of this International Accounting Standard number 7, we are said to have invested money. Why? Because we expect to use the non-current asset for more than one future period. Okay, so that's an investment. Then, when we also dispose of that asset, we are also said to have participated in an investing activity, although this time um, we have disposed of that asset. Okay, but the purchase or the disposal all fall under one heading, the investing activity. Lastly, we've got cash flows from financing activities. This regards how the business finances its expansion through shares and non-current liabilities. So when we issue ordinary shares to the public, okay, we end up receiving share proceeds, okay, or proceeds from issue of shares, and those are accounted for under the financing activities. We have issued shares to acquire finance from members of the public. Okay, then when we also get a loan or funds from a loan facility or repaid that loan, we are also being said to be participating in financing activities. So all those are reported in this, under this heading. Now, presentation of the operations or operating activities section. This is the section which we said is the first section of the statement of cash flows. And this is the section which is presented in two ways, either the direct method or the indirect method. Okay, the rest of the sections are just the same. They are presented in the same way. They don't change. But this one, the first one, is the one that can be presented in two different ways. However, the ultimate figure, whether we have used the direct method or indirect method, should be the same. Okay? Now, let's look at how we have to prepare a cash flow statement. All right? We'll need information from the financial statements, but basically we'll be needing the statement of profit or loss and other comprehensive income, or in short, the income statement, and the statement of financial position, formerly the balance sheet. Okay, so these are the two financial statements which we'll be using. Okay, we'll be using these two, to come up with a statement of cash flows. All right. Now, when we are talking of the statement of financial position, we'll need two such statements. Okay, we need the current year as well as the previous year statement of financial position. Without without one of the two, then it is impossible to prepare a statement of cash flows. All right. So we need the previous year as well as the current year statement of financial position. Now, how do you prepare or present the cash flows from operating activities section under the direct method? As you can see on the screen, this is how how the statement will look like. Okay, it has to be given a heading: cash flows from operating activities. Remember, under the direct method, cash flows are reported under major classes of gross receipts and gross payments, as you can see on the screen. We do not have to give each and every item an entry on the face of the statement of cash flows. Why? Because we might end up producing a very long statement of cash flows, and if information is overloaded, by the end of the day, the users of the financial statements are going to be tired, and they will lose interest in reading or using your statement of cash flows. And this means that your objective would have been defeated. So we need to ensure that we have grossed up the receipts and the payments in major subheadings, like the cash receipts from customers, okay, cash receipts from suppliers, cash payments to employees, cash payment for other expenses, interest payments, tax payment. Okay. Usually, depending on the information provided by the examiner or provided by the entity, usually the payments to employees and other creditors is usually considered a single entry, okay, or a single class of information, which means they normally they are normally bunched as one entry. Okay, you shall see as we proceed. Now let's use the information on the screen here. All right, on my left, okay, there is the statement of profit or loss, or the income statement for the year 2023, where we are having the sales figure of 100,000, the purchases, and we're told that all the items which were purchased were sold. Okay, so the purchases were 60,000, which means in this case the examiner is trying to tell us that there were no closing stocks. Okay, there were no closing stocks, and as you can see again on the statement of financial position extract here, we just have to assume that there were no opening stocks as well. Okay, so which means that the stocks, the inventories should not be a bother. In this case, there were no opening or closing inventories. So the assumption would be that the purchases there are representing the cost of sales. All right, the purchases figure there is also representing the cost of sales. So we have got the sales, the purchases, the interest expense, all right, the tax expense, and depreciation charge, okay, expense, operating expenses, and then profit before tax. All right, that's information from the income statement. And then the information from the statement of financial position, okay, for our interest. Remember, we are only having information which relates to the operating activities, all right, section. All right, so the current assets and current liability section of the statement of financial position are the very important information we need, okay, for us to work out that section of the statement of cash flows. All right, now since we are computing this cash flow using the direct method, remember we have got these standard entries, okay, that is the cash receipts from customers, cash payments to suppliers. Remember, the cash receipts from customers are inflows, so they are represented by a positive figure. However, all the payments are going to have are going to be in negative form, representing cash outflows. Okay, so we using the figures there, we need to compute first the cash receipts or cash received from customers. How do we do that? On the left side of the screen, you can see on the top left side there that to compute the cash received from customers, you need to have the opening receivables balance, which was 10,000, and this is found in the statement of financial position. That's where we get the receivables figure, okay, and that's the opening is the 2022 figure, okay. Forgive me, there it should be 2023, 2022 and 2023, okay, right there. It's only that I don't have a pen. It's fine. So that's the opening figures are for the previous year, that is the 2022 year, and the current year should be 2023. So the 10,000 is our opening figure for the receivables, as you can see on the screen there, and we then have to add the sales. Okay, add the sales. The sales are shown in the income statement as 100,000 there, as you can see, the 100,000, and 10 plus 100, that's 110,000. And then we have to deduct the closing receivables balance. The closing receivables balance was 12,000 from the statement of financial position there under the 2023 year. Okay, so the ultimate cash received from customers is 98,000. All right, so that's how you calculate your cash receipts from customers. Okay, excuse me. No noise, no noise, no noise. No noise. I'm sorry there. Okay, now so that's 98,000 as our cash receipts from customers. All right. Okay. Let me just. Okay. Continuing. So you can see that this is how we have to calculate the actual cash that was received from customers. All right. We have used both the income statement and the statement of financial position. All right. In the exam, we are not going to be given these figures freely. Okay. And these are the formulas which you need to use. So you can also see that for us to calculate the cash payments to suppliers, we need to follow the same way. We need to use the opening balance of payables. Okay. You can see that the payables, the opening balance was 8,000. All right. And then we add the purchases. The purchases were 60,000 from the income statement. Okay, and we get 68,000. And then we deduct the closing payables. That is 6,000. And our ultimate cash payment was 62,000. That's how we calculate the actual cash which was paid to suppliers. Now in the examination, what could be confusing would be that instead of being given the purchases figure there, the examiner might give you the cost of sales figure. And you then have to lead yourself to calculate the purchases figure. Now we know that the cost of sales are found by adding the opening inventory, okay, the opening inventory figure, and the purchases, okay, and the purchases, and deducting the closing inventory figure. Okay, so it's opening inventory, add purchases, less closing inventory, and you get your cost of sales. Now, if you are given the cost of sales figure, you then have to ensure that you make the purchases figure subject of the formula. Okay, so you need to first write down the formula for the cost of sales, which is equal to opening stock or opening inventories plus purchases minus closing inventory. That's the closing stock, or I mean the the cost of sales figure, the cost of sales formula. Okay, now when you get that formula correct, you then have to make um, the purchases as the subject of the formula. Okay, so you make purchases subject of the formula. Now, we have, we have done equations at ordinal level, and that shouldn't be um, a source of confusion. Okay, now, so you can see that all these payments are found using the sum formulas. Okay, opening if you want to calculate the tax paid, the actual tax which was paid, you then have to use the same principle, even the interest paid. All right. Now, what is important? What is important is that you just have to lead yourself using this the template. Okay, you must use the template always. All right, because if you don't have the template, then you are likely to be lost along the way. So know this, memorize these items, okay, because they are very essential. If the examiner says that I want you to calculate or to present the first part of the cash flows of the cash flow statement, that is the cash flows from operating activities section, I want you to present it. So this is how you do your computations. These are the entries you have to put in that section, and then this is how you are going to calculate the section. Okay. Sorry, what's going on with my screen here? I'm using a phone, so sometimes it misbehaves. Okay. Now, these were the computations. We've discussed that aspect. Okay, I'm sure you're seeing it now. All right. Now, there is a very important figure which I said that usually the payments to other creditors, which include employees, is a payment that is usually done after you have dealt with the major ones. Okay, this one now, instead of using the principle, I would rather suggest that you then have to use the formula which I've presented here. Okay, this figure takes into consideration all the operating expenses a business could have incurred. Okay, all the expenses, and then you deduct those non-cash expenses. For example, the depreciation. Okay, remember, operating expenses are the expenses which exclude interest and tax. Okay, so in this we just have to consider all those items other than interest and tax. All right, so the depreciation, okay, amortizations and so forth, those ones have to be deducted. All right, and so that's payments to other creditors and suppliers is equal to operating expenses minus depreciation minus decrease in prepaid expenses. So if we come back to our information here, we are told that the operating expenses were 26,000, and the depreciation charge was 6,000, right? And um, a decrease in the prepayments. Prepayments are seen under the current assets. Okay, prepayments are expenses which have been paid in advance, so they are seen as current assets. Of course, in this question we didn't have those prepayments, so don't worry. We put a 0, okay, and we can see that the actual payment which was made to other creditors and suppliers was 20,000. Remember, I said the other creditors include also employees. Employees can be considered creditors to the company. They are creditors to the company as well. Okay, they supply labor. Okay, but they are not trade creditors. So this is why we call them other creditors. Okay, now this is the presentation. Okay, all these figures have been taken from our workings. Like for example, the cash received from customers was 98,000. This is the figure which we found on the top right corner there. The cash received from customers 98,000. Cash paid to suppliers was 62,000, and this is the same figure which we present here. Are we together? All right, so the direct method is done. Now this is the indirect method, and as you can see, this is the template. The heading is just the same: cash flows from operating activities. Under this method, cash flows are calculated by adjusting the net profit before interest and tax for non-cash items and movements in working capital during the reporting period. So we need to calculate this cash flow, or I mean, we need to calculate the cash flows by first adjusting, by adjusting the net profit before interest and tax for non-cash items and movements in working capital during the reporting period. So those are the adjustments which are required. Okay, so you can see that the heading is just the same: cash flows from operating activities, and then profit before interest and tax is a positive figure there. As you can see, sometimes there could be a loss before interest and tax. If it is a loss, you then put that figure in a negative, in negative form. Then you add or deduct non-cash items such as depreciation, profit on sale of non-current assets. Ladies and gentlemen, I want you to realize something. Here I have put the profit before interest and tax. But in the exam, you might be given profit before tax only. Then you need to then also include on your adjustments the interest expense. If the examiner gives you the profit before tax only, not the profit before interest and tax, then you need to also adjust for the interest expense or the finance cost. All right, then you also have to adjust for the working capital movements. Okay, the increase in current assets. If current assets increase, then we consider that one an outflow. Okay, for example, if the receivables have increased, then we consider our money being idle with customers, or customers are failing to pay us money. So this is why they are increasing. They are taking time to pay us money, so it's an outflow to us. Then increase in inventories. If our stocks have increased, stocks are current assets as well. If they have increased, it means that we are taking time before selling items. So money is just being held in stocks. So that's again an outflow. Then decrease in current assets, that's a positive, that's an inflow. If the stocks have decreased, if the receivables have decreased, then we say that customers have paid or stocks have been sold, so respectively. So that means that we are getting money, we are earning money. So, similarly, increase in current liabilities is a positive figure. Current liabilities are credit suppliers. So, if they are increasing, it means that we are getting stocks for free. We are being given generous terms. So that's a cash flow advantage. Okay, so we are getting inflows, right? But if they decrease, then we are making out payments. We are making payments to suppliers, so that's a decrease in cash flow. So that's an outflow. Then interest paid. That one is just the same way. We calculate the interest paid in the same way we calculated it under the direct method. The tax paid, we calculate them again under the same principles. Then we get your net cash flow, from operating activities. All right, that's the template, ladies and gentlemen. Now let's see how we do the computation. As you can see, these are the figures. Remember, like I said, they produce the same answer, 3,000, as the net cash flows from operating activities. This is the same figure which we found here, 3,000. Okay, how did we arrive there? All right, now this one, because the information given was not profit before interest and tax, but we are given profit before tax, then it means that you also need to adjust for the interest expense. Okay, the interest expense is to be adjusted for. So as you can see on the presentation here, you start with the profit before tax, 11,000 as given in the question, and then the depreciation charge was also given as 6,000 in the question. Then the finance cost, 3,000. The finance cost is the interest expense, that is the 3,000. Remember, when we arrive at the profit before tax, we had deducted the depreciation, we had deducted the interest expense. Now we are adding them back. So this is why they are in positive. We are adding them. You need to add all the costs or the losses on disposal and so forth. Those losses or the costs are added back. Okay, the gain on disposal has to be deducted. Why? Because we had added it when we were calculating the profit before tax. So that's the trick there. Then increase in receivables. Like I said, increase in receivables are going to be considered as an outflow. Okay, it's money getting out of the business. Why? Because it is being held by the customers. They are not paying us the money. It's our money that is being held in their hands. So it's an outflow to us. Decrease in payables. As payables are decreasing, it means that we are repaying suppliers. So therefore, it's an outflow. Tax paid, we compute this one using the same principles. Okay, that is the opening tax payable, add the tax expense for the year, and then less the closing tax payable, and we arrive at the actual tax paid. For the interest paid, we do the same. The interest payable opening balance plus the interest expense in the statement of profit or loss and other comprehensive income, that is the income statement, and then the closing interest payable, we arrive at the interest which was actually paid. And then we sum them all these figures up, we get the net cash flows from operating activities. Like I said, all the remaining sections, that is the section for the cash flows from investing activities and cash flows from financing activities, they all follow the same principles. Okay, they all follow the same principles, and they are just the same. They are presented in the same way. Okay, now I think this is justice for you guys. And if you want to learn more, please get in touch with me on those numbers, okay? Or just send me an email, all right? I'll always be there and I'll be listening, all right? Until next time, please continue to feel excited, very, very excited. Good day.